The second largest asset manager in the world just made a move that contradicts everything Wall Street is telling you, a move that goes against every talking head on CNBC, a move that most retail investors will ignore until it is too late. Vanguard. $11.6 trillion under management, 50 million investors worldwide. The company that invented index investing. The company that has been right more times than anyone can count. Just released their 2026 outlook. And hidden inside that report is a clue, a $4.7 trillion clue. What is the clue? Vanguard is flipping the script. They are telling you to do the opposite of what everyone else is doing. While retail investors pile into AI stocks, while the Magnificent Seven hit all-time highs, while tech valuations reach .com levels, Vanguard is saying, get out. Their exact words. Risks are growing amid the AI exuberance. Their recommendation? 60% bonds, 40% stocks. Not 60% stocks, 40% bonds. The opposite. They are inverting the traditional portfolio, the portfolio that every financial advisor has recommended for decades. And they are doing it with $4.7 trillion of their own money. That is the clue. $4.7 trillion in fixed income assets, positioned for what they see coming. So what does Vanguard see? What do they know that the rest of the market does not? Why is the most conservative, most data-driven, most respected asset manager in the world telling you to buy bonds and sell tech stocks? Today, I'm going to show you exactly what Vanguard sees. I'm going to show you their return projections that will shock you. I am going to show you why they think U.S. stocks will return only 4 to 5% for the next decade. I am going to show you why they think bonds will match or beat stocks. I am going to show you the historical pattern they are following. I'm going to show you how every technology bubble ends the same way. And I am going to show you how to position yourself before the crowd figures it out. Because when $11 trillion moves, it creates waves, and those waves are already forming. Let us begin. Part 1. Who is Vanguard and why should you care? Before I show you what Vanguard sees, let me explain why you should care. Because this is not some random hedge fund making a prediction. This is not some YouTuber with a conspiracy theory. This is not some newsletter writer trying to sell subscriptions. This is Vanguard. The numbers, $11.6 trillion in assets under management. That is more than the GDP of every country except the US and China, more than Japan, more than Germany, more than the UK, France, and Italy combined. Managed by one company. The history, founded in 1975 by John Bogle, the man who invented the index fund, the man who democratized investing, the man who proved that low-cost, passive investing beats active management over time. Vanguard has been right about the big trends for 50 years. They were right about index investing. They were right about low fees. They were right about the long-term power of bonds. They were right about international diversification. When Vanguard speaks, smart money listens. The structure. Here is what makes Vanguard unique. They are owned by their investors, not by shareholders, not by private equity, not by Wall Street banks, by the people who invest in their funds. This means they have no incentive to mislead you. They make money when you make money. Their interests are aligned with yours. This is why their research is trusted. This is why their predictions matter. This is why you should pay attention to what they just said. The track record. 84% of Vanguard mutual funds and ETFs have outperformed their peer group averages over the past 10 years. 84%. That is not luck. That is not marketing. That is systematic excellence. When a company with this track record makes a major call, you listen. And they just made the biggest call in years. Part 2. The shocking prediction. U.S. stocks, only 4 to 5% returns. Now let me show you what Vanguard actually said, because this is the part that should wake you up. In their 2026 Economic and Market Outlook, Vanguard projects, U.S. stock returns. Over the next 5 to 10 years, 4% to 5%, 4 to 5% per year for the next decade. Let that sink in. The S&P 500 has averaged 10% annually since 1957. Vanguard is telling you to expect less than half of that, less than half, for the next decade. And here's the kicker. They say this is nearly single-handedly driven by our risk-return assessment of large-cap technology companies. Translation, tech stocks are going to drag down the entire market. The same tech stocks that have driven the market higher for years. The same tech stocks that everyone is piling into. The same tech stocks that your Robinhood account is full of. Vanguard is saying they are overvalued. Dangerously overvalued. And they are going to disappoint. Why tech will disappoint. Vanguard gives 2 reasons. Reason 1, already high earnings expectations. The market is already pricing in massive AI profits. The valuations assume everything goes right. They assume AI transforms every industry. They assume the current leaders maintain their dominance. They assume profit margins stay elevated. If any of these assumptions are wrong, and they often are, disappointment follows. Reason 2, The typical underestimation of creative destruction from new entrants. And this is the big one. In every technology cycle, the early leaders rarely stay on top. The companies that build the infrastructure rarely capture all the profits. New entrants come in, competition increases, margins compress. The railroad companies did not capture all the value from railroads. The telecom companies did not capture all the value from the internet. The hardware companies did not capture all the value from mobile. Why should AI be different? NVIDIA is printing money today, but who will be printing money in 5 years? 10 years? History says probably not NVIDIA. History says probably someone we have not heard of yet. History says the picks and shovels providers always face competition eventually. Vanguard sees this pattern. They have seen it repeat for decades, and they are positioning accordingly. Part 3. The bond bull case. Why Vanguard says bonds are back. Now here is where it gets interesting. Vanguard is not just bearish on stocks. They are bullish on bonds. Very bullish. Bond return projection. Stood on 4% annually. That is right. 4% from bonds, 4 to 5% from stocks. The same return. But bonds have less risk, less volatility, less drawdown potential, more income, more stability. Why would you take stock market risk for the same return you can get from bonds? Vanguard's answer, you should not. Why bonds are attractive. Now, reason. 1. Higher interest rates. After years of zero rates, bonds finally pay income again. The 10-year Treasury yields over 4%. Corporate bonds yield 5, 6, 7%. Municipal bonds offer tax-free income. For the first time in 15 years, bonds offer real returns. Returns above inflation. Returns you can live on. Returns that do not require you to gamble on stock market volatility. Reason 2. The Fed is done hiking. Interest rates are near their peak. When rates fall, and they will eventually, bond prices rise. You get the income plus capital appreciation. This is the best of both worlds. Reason 3. Diversification in a crisis. What happens if AI disappoints? What happens if the economy slows? What happens if we get a recession? Stocks crash. Bonds rally. This is the classic diversification benefit. And Vanguard says there is a 25 to 30% chance AI disappoints. Those are not small odds, 1 in 4. If you are all in stocks and AI disappoints, you get crushed. If you have bonds and AI disappoints, you are protected. Vanguard's exact words. U.S. fixed income should also provide diversification in a world where AI disappoints, leading to lower growth. They are hedging. They are protecting. They are being smart. The 60-40 flip. Here is the headline. Vanguard's recommended portfolio allocation for 2026, 60% bonds, 40% stocks. Not 60% stocks and 40% bonds, the opposite. This is revolutionary. For decades, the standard recommendation was 60% stocks, 40% bonds. That was the balanced portfolio. That was what every financial advisor recommended. That was the default. Vanguard just flipped it because the math has changed, because valuations have changed, because the risk reward has changed. When stocks and bonds offer similar returns, you take the less risky option. That is investing 101. And right now, the less risky option is bonds. Part 4. What else? Vanguard recommends value and international stocks. Bonds are not the only opportunity. Vanguard sees 2 other areas that will outperform. Opportunity 2, U.S. value stocks. While growth stocks are overvalued, value stocks are not. Value stocks trade at lower price to earnings ratios. Value stocks pay higher dividends. Value stocks have been ignored for years. While everyone chased NVIDIA and Tesla, value stocks languished. But that is changing. Vanguard's projection, value stocks will outperform growth stocks over the next decade. This is the historical pattern. Growth leads, then value leads. The pendulum always swings, and it is about to swing toward value. Opportunity? 3. International developed markets. While everyone is obsessed with America, the rest of the world is getting cheaper. European stocks trade at significant discounts to U.S. stocks. Japanese stocks are finally emerging from decades of stagnation. Developed market valuations are more attractive than U.S. valuations. Vanguard's projection, non-U.S. developed markets will outperform U.S. markets over the next decade. This is contrarian. Everyone thinks America is the only game in town. Everyone thinks U.S. tech will dominate forever. Everyone thinks international stocks are dead money. Vanguard disagrees. They see value in Europe. They see opportunity in Japan. They see diversification benefits in going global. The ranking. Vanguard's capital market projections show the strongest risk-return profiles over the coming 5 to 10 years are, in order, number 1, high-quality U.S. fixed income. Number 2, U.S. value-oriented equities. Number 3, non-U.S. developed market equities. Notice what is not on this list? U.S. growth stocks, U.S. tech stocks. The Magnificent Seven, the AI darlings. Vanguard is telling you these are the worst risk-reward opportunities right now. Not the best, the worst. And they are positioning $4.7 trillion accordingly. Part 5, the historical pattern. What happened after every tech bubble? Now let me show you why Vanguard is so confident. Because this has happened before. Every single technology bubble in history has ended the same way. The railroad bubble, 1850s, 1870s. Railroads were the AI of the 19th century. Everyone was investing. Fortunes were made. The future seemed limitless, and then it crashed. Most railroad companies went bankrupt. The ones that survived did not capture most of the value. The real winners were the companies that used railroads, the industrialists, the commodity producers, the retailers, the consumers of railroad technology, not the producers. The radio bubble, 1920s. Radio was going to change everything. Every home would have one. Every company would advertise. The future was wireless. And it was true. Radio did change everything. But most radio companies went bust. The survivors were consolidated. The real winners were the companies that used radio, the advertisers, the entertainment companies, the consumer goods companies, the dot-com bubble, 1990s, 2000. The internet was going to change everything. Every company needed a website. E-commerce would transform retail. The future was digital. And it was true. The internet did change everything. But most dot-com companies went bust. The NASDAQ fell 80% from peak to trough. Companies like Cisco, Intel, and Microsoft lost 70, 80, 90% of their value. And they never recovered to their 2000 highs for over a decade. The real winners? Companies that use the internet. Amazon survived. Google came later. The cloud computing providers came later. The social media companies came later. Not the fiber optic companies. Not the telecom equipment makers. Not the first movers. The pattern. Vanguard sees the pattern. Technology transforms the economy. True. Early investors make fortunes. True. Current valuations are justified. False. Current leaders will capture all the value. False. The pattern is always the same. The technology is real. The transformation is real. But the valuations are excessive, and the winners change over time. AI will transform the economy. But Nvidia at these valuations, Microsoft at these valuations, Google at these valuations, history says probably not. History says the value will flow to the users of AI, not the builders. History says new competitors will emerge. History says margins will compress. Vanguard sees this. They have studied this for 50 years. And they are positioning accordingly. Part 6, the 4.7 trillion clue, what Vanguard is actually doing. Now let me show you the clue, the $4.7 trillion clue, because talk is cheap. What matters is action, and Vanguard's action speaks louder than any research report. Vanguard's fixed income empire. Vanguard manages approximately $4.7 trillion in fixed income assets. That includes the Vanguard Total Bond Market Index Fund, $384 billion. The Vanguard Total International Bond Index Fund, $134 billion. The Vanguard Short-Term Bond Index Fund, $68 billion. The Vanguard Intermediate Term Bond Fund, $50 billion. Dozens of other bond funds, municipal funds, money market funds, plus the bond allocations in their massive Target Retirement Fund series, $1.48 trillion. Combined, Vanguard has more money in bonds than most countries have in their entire economies. This is not a hedge fund making a speculative bet. This is the most conservative, most data-driven asset manager in the world, putting their money where their mouth is. The inflows. In 2025, Vanguard saw massive inflows into fixed income. Investors are listening. Smart money is moving. The 4% yield on high-quality bonds is attracting capital. Capital that used to chase stocks. Capital that used to chase growth. Capital that is now seeking safety and income. What this means, when the largest bond manager in the world says bonds are attractive, they are not just talking. They are managing trillions based on this view. They are allocating client assets based on this view. They are building portfolios based on this view. This is the clue. $4.7 trillion says bonds over stocks. $4.7 trillion says caution over exuberance. $4.7 trillion says the smart money sees what is coming. Part 7. The risks Vanguard sees. What could go wrong? Now let me show you the risks Vanguard is worried about. Because understanding the risks helps you understand their positioning. Risk 1. AI. Exuberance turns to disappointment. Vanguard estimates a 25 to 30% chance that AI disappoints, that the investment boom stalls, that the productivity gains do not materialize, that the earnings growth expectations are not met. This is not a small risk. This is a 1 in 4 chance of massive disappointment. And if it happens, tech stocks crash. The Magnificent Seven become the mediocre seven. The portfolios concentrated in growth get destroyed. Risk 2. Valuations are stretched. US stock valuations are at historic highs. The Shiller PE ratio is above 30. That has only happened 3 times in history. 1929, before the crash, 2000, before the dot-com bust, 2021, before the correction. Every time valuations reached these levels, disappointing returns followed. Not immediately, not predictably, but inevitably. Vanguard knows this. They are not predicting a crash, they are predicting muted returns. 4 to 5% instead of 10%, because valuations matter over the long term. Risk 3, creative destruction. The companies on top today will not be on top tomorrow. This is the nature of technology. This is the nature of capitalism. This is the nature of competition. NVIDIA dominates AI chips today, but AMD is catching up. Intel is trying to catch up. Custom chips from Google, Amazon, Microsoft are emerging. China is developing alternatives. Competition always comes. Margins always compress. Market share always shifts. Vanguard knows this pattern. They have watched it repeat for 50 years, and they are not betting on the current leaders maintaining dominance. Risk 4. Interest rates stay higher. If inflation remains sticky, rates stay elevated. If rates stay elevated, growth stocks suffer, because growth stocks are long-duration assets. Their value depends on future earnings. Future earnings are worth less when rates are high. This is Finance 101, and Vanguard expects rates to stay higher than the market expects. Their Fed forecast is a bit more hawkish than the bond market's expectations. This is bearish for growth stocks. This is neutral to bullish for bonds. You get the income. This is another reason to favor fixed income. Part 8, how to position following the smart money. So what should you do? How do you position your portfolio based on what Vanguard sees? Here's the playbook. Step 1, reduce tech overweight. If your portfolio is heavy in tech stocks, consider rebalancing. You do not have to sell everything. But if you are 70, 80, 90% in tech, you are taking concentrated risk. Risk that Vanguard, with $11 trillion, thinks is poorly compensated. Trim your winners. Take some profits. Diversify. Step 2, add high-quality bonds. Vanguard's top recommendation is high-quality U.S. fixed income. This means treasury bonds, investment-grade corporate bonds, municipal bonds for tax efficiency, bond index funds like B&D, Vanguard Total Bond Market ETF. These are not exciting. They will not make you rich overnight, but they will provide 4% income, downside protection if stocks crash, lower volatility, better sleep. Step 3, consider value stocks. If you want equity exposure, tilt toward value. Value stocks are cheaper. Value stocks pay dividends. Value stocks have been ignored for years. The pendulum is swinging. Funds like VTV, Vanguard Value ETF, offer diversified value exposure. Step 4, add international developed markets. Do not put all your eggs in the American basket. Europe is cheap. Japan is improving. International diversification reduces risk. Funds like VEA, Vanguard Developed Markets ETF, offer easy access. Step 5, consider the 60-40 flip. If you are conservative, consider Vanguard's recommended allocation, 60% bonds, 40% stocks. This is not for everyone. If you are young and aggressive, you might stay heavier in equities. But if you are approaching retirement, if you value stability, if you want income, the 60-40 flip makes sense. Vanguard would not recommend it if they did not believe in it. Part 9, what if Vanguard is wrong? The bull case. Now let me steelman the other side. What if Vanguard is wrong? What if AI does transform everything? What if tech stocks keep running? The bull case. AI could be different this time. The productivity gains could be massive. The current leaders could maintain dominance. The earnings growth could exceed expectations. If this happens, tech stocks could return 15, 20, 30% annually, and bonds would look foolish. 4% versus 30%. You would miss out. Vanguard's response. Vanguard acknowledges this possibility. They say there is a 60% chance AI delivers. They say US tech could continue to perform in 2026. They are not saying sell everything. They are saying the risk reward has shifted. They are saying diversify. They are saying do not bet everything on one outcome. Even if AI delivers, value stocks and international stocks will benefit. The consumers of AI technology will capture value. The economy will grow. Everyone will participate. You do not need to own NVIDIA to benefit from AI. You can own the companies that use AI to become more productive. You can own the international companies that adopt AI. You can own the value stocks that integrate AI into their operations. Diversification is not bearish. Diversification is smart. And that is what Vanguard is recommending. Part 210, the timeline. When does this play out? The final question, when? When do tech stocks underperform? When do bonds shine? When does the flip happen? Vanguard's view, 2026 could see continued tech momentum. The investment cycle is still underway. Earnings growth is still strong. But over 5 to 10 years, the math catches up. Valuations matter over the long term. Competition emerges. Returns normalize. This is not a prediction for next quarter. This is a prediction for the next decade. The catalyst, what could trigger the shift? An AI disappointment, a recession, a credit event, rising interest rates, geopolitical shock. Any of these could start the rotation. But you do not need a catalyst. The shift can happen gradually. Value can outperform growth by 1% per year for 10 years. That adds up, that compounds, that changes portfolios. The message, do not try to time it. Do not wait for the perfect moment. Position now, diversify now, add bonds now, add value now, add international now. Because when $11 trillion moves, you want to be ahead of it, not behind it. So here's where we are. Vanguard, $11.6 trillion under management. The second largest asset manager in the world. The most respected name in investing. Just told you their plan. Bonds over growth stocks, value over growth, international over domestic, 60% bonds, 40% stocks, 4 to 5% expected returns from U.S. equities, 4% expected returns from bonds. The same return with less risk. This is not a prediction from a random analyst. This is not a YouTube conspiracy theory. This is not a newsletter trying to scare you. This is Vanguard, with $4.7 trillion in fixed income, putting their money where their mouth is. They see what most people do not. They see the AI exuberance. They see the stretched valuations. They see the historical pattern. They see the risks growing, and they are positioning accordingly. The question is, are you? Are you still all in on tech? Are you still ignoring bonds? Are you still following the crowd? Or are you following the smart money? The $4.7 trillion clue is right in front of you. Vanguard is showing you what they see. They are showing you how they are positioning. They are showing you what the next decade might look like. The choice is yours. You can ignore it. You can chase the momentum. You can hope tech keeps running forever. Or you can listen. You can diversify. You can position for the risks. You can follow the largest, most successful asset manager in history. Because when Vanguard makes a call this big, with this much conviction, with this much money behind it, you pay attention. The $4.7 trillion clue has been revealed. What you do with it is up to you. If this video opened your eyes, hit the like button. If you want more insights on what the smart money is doing, subscribe. Comment below, do you agree with Vanguard? Are you adding bonds? Share this with everyone who is still all in on tech. They need to see what the smart money sees. Remember, this is educational analysis, not financial advice. Do your own research, make your own decisions, but make them with your eyes open. Vanguard showed you the clue. $4.7 trillion cannot be wrong.